This week on the podcast, let's look at some market predictions from the past. Let's look at the first quarter's performance and some of the volatility we've been experiencing and let the guys break it down for us. Let's get it going. Hey everybody, welcome to the podcast. Thanks for hanging out with us here on Retirement Approved with Matt and Steve Paul. And we got a good show lined up this week. Guys, what's going on, Matt? How are you doing, buddy?
I can't complain. I got my Spartans in the tournament, the Tigers season starting, April and the D about to start. So
yeah,
Steve, buddy. I'm looking forward to that. We're recording on Wednesday, so the Tiger season starts tomorrow, right? First game, but we've got the defending champs, right? LA.
Yeah. Well, speaking of baseball, what's with this article? You got a little article action?
So the markets have been volatile. So I took the opportunity to write about baseball. Steve
as
and the guys
do
here, at the office made fun of me because my article turned out to be a simple analogy on baseball into 50%, talking about the 1990s, the Atlanta Braves, and how the Tigers were terrible. I ranted about Bally Sports, how they won't let me watch my Tigers. But at the end of the day, the whole point of the article was to say, stay calm under pressure, just like a pitcher. I know I didn't have the fastest fastball.
He's talking about the precision of Greg Maddux and then the crazy market that we're dealing with right now. Where are you going with this?
All right. I kind of like it though. Crazy market. Maybe Randy Johnson might have been a good one to go with,
I was saying John Rocker. I don't know if you remember that.
Yeah. A lot of
crazy closer on the Braves team Matt was referencing that would sprint out to the mound and then throw 98 mile an hour fastballs all over the place.
Yeah. Very true.
I thought it was a perfect analogy, and then I wrapped Bally Sports and how they charge you an extra fee to watch now if you're not a normal Comcast cable.
So are you guys still Bally's there? Because they switched. We're FanDuel now. They bought it out.
Bally went bankrupt and got acquired by FanDuel. So I guess I'll be paying that price maybe tomorrow.
See, there he goes lying again. He knows he's not paying for it. He's just going to text me for my password like he did last year.
Yes. Hey, don't say that because they might say they'll send you a thing and say you can't do that.
We'll see if they have that.
Like Netflix.
Cut that out.
Yeah, one household per, right? All right. Well, let's talk about that. So cool that you did the article though. So let's talk about what's going on out there. Smells like fear a little bit, right?
Yes. Fear is in the air. Spring is in the air, but we experienced our first 10% correction in a while. So we hit, this is the CNN fear and greed indicator. We hit extreme fear earlier this month in March, and it's kind of ticking back up to fear, getting closer to that neutral range. But then today, there's been more news on tariffs that have caused more fear in the market. So markets are taking a pullback, and really, I think we're just waiting for April 2nd and some certainty to roll around.
At this point, the president talked back on Monday and said, "Hey, look, I might dial these tariffs back," and we saw a nice run in the market. And then, right before we went into record the show today on Wednesday, he talked again and said, "Hey, maybe not so much. We'll see." So it's just there's so much uncertainty surrounding these tariffs at this point. We don't know how they're going to play out. We don't even know what will happen between now and April 2nd. There could be more news that comes out. So we just kind of have to take the wait and see approach here. And that's why, honestly, our hands-off investors are just doing really well right now. And most of our clients are buy and hold investors. Most of our clients are in their 50s, 60s, 70s. They've been through periods like this. They know they're not going to be able to time the market and get in and out. They're trusting the allocation, and they're moving through a period like this. In fact, we had one client that came in, and I sat with him last week, and he goes, "I watched your predictions episode." And he's been down in Florida just golfing, having a good time, ignoring the market. He goes, "I watched your predictions episode, and you called for a 10% pullback. Do you still think we're going to see that?" And I go, "Well, we did see that."
Right.
It happened. Right. We went through it, and now we're almost back to even. We're going to see a lot of volatility. But those are the type of investors that we like, where it's like, hey, I trust the allocation. I know we're going to move through this. We've seen this volatility with tariffs before. Back in 2018, we were dealing with China and the trade war and the tariffs then. We saw a 20% pullback that we recovered from. We feel it'll be the same way this time, but we talked about the uncertainty surrounding the tariffs and how that was going to cause a lot of volatility.
Yeah, we've been saying this 10% correction has been the least painful correction that we could endure, because we went up about 10%, down about 10%. Now we're S&P's down slightly, but a diversified investor probably break even, maybe even positive, because we've seen emerging markets, international value
Right.
really hold their value a lot better.
Yeah, most of our clients that are in those 60-40 blends that are diversified throughout the different asset classes, sectors, are seeing what a downside of, they saw maybe 4%, 4 or 5%. So I mean, now back to close to even. So I'm not saying that we might not see something like that again. We'll get into our predictions. I called for that 10% correction. I think we could see possibly another one. We were just talking about that before the show, another pullback. But again, we got to see how this all plays out over the next couple of weeks, couple months,
Well,
really.
guys, is kind of just the consumer advocate, if you will, here. You guys are obviously in the trenches every day. I mean, corrections are normal, and we've had pretty good runs for the most part, right? So to your first chart there you were showing, Matt, extreme fear over 10% seems a little ridiculous to me. It's like caution, sure, but does extreme fear make sense when it's just 10%? I don't know, right?
Yeah,
Seems like a broken
probably
record.
not. I think emotions are high right now just because of the environment
Sure.
we're in politically.
Sure.
So that's probably why it's contributing to, because you have to
Fair
remember
enough.
10% corrections are fairly normal, right?
Pretty normal. Yeah.
Happen about every year and a half. And if
Yeah.
we're talking 5% corrections, we see 3 or 4 of those a year. People
Yeah.
don't realize it because right now, I mean, you're just reading the headlines, and to be honest, the tariffs are divisive, and the headlines are just pissing people off.
Yeah. Well, yeah, they're it's that broken record of panic inducing stuff, right? I mean, that's the point, right?
Yeah. So when we did our predictions episode, we did not talk about the various predictions from financial firms out there. So I wanted to go over that.
Sure.
This is 2025 predictions from the largest financial institutions. Everyone was consensus bullish for the most part at the beginning of the year, with the exception of our friends over at First Trust calling for a market correction. And the S&P is still at 57, 5,800. Not sure what it's at exactly today because it's moving, but we're probably on track for over 6K. But that's, again, it's this tariff craziness, so we
Got a ways to
don't
go
know
to get
what's going to
there.
happen. Yeah, but
Yeah.
what we've seen is some of these companies, Yardini, for example, you see them on the right side of your screen there. They've actually adjusted their price target. So they cut their price target from 7,000 to 6,400. And the reason for that is not because they're expecting lower earnings growth. They're actually very bullish on earnings. They're just saying the fundamental value of the S&P 500 is going to see a valuation correction, because we had talked about on prior episodes that valuation of S&P has been sneaking up and up and up, and this was overdue. And we're gonna see periods of correction. So
Is it all just tariffs, or is it also, like we've talked about as well, some of the tech stuff just being so overweighted, right?
yeah, that's a great point. We've seen NVIDIA, they're taking it on the chin again today, down about 6% when we hopped on the call. And that's because China is limiting sales of chips due to environmental concerns, probably more like a reciprocal tariff type thing. But
Mm-hmm.
that's been leading everything down a little bit. And the Mag 7 overall, we had talked about making sure you weren't overly concentrated for pretty much all of 2024. That was our theme, and now diversification's finally starting to pay off. But those Mag 7 companies were such a core part of the S&P at this point. That's why we're seeing a significant pullback.
So with all that being said, let's take a look at your first prediction here. S&P 500 over 7,000.
Yeah.
Staying
Well,
true to that?
I was going to say he still has the whole year to go, right? Technically.
Yeah. We're only end of March here. We got 3 quarters to go. I'm gonna be stubborn and stick to my target. I'm not adjusting like Yardini. I think there's a lot of innovation, a lot of wonderful tech going on. But if you recall, when we did that predictions video, I said, hey, just as easily the S&P could be negative. That's how meaningless these predictions are.
It's definitely a bold prediction on your end there. I don't. I think I'm going to end up right on this one still, between 5 and 8%. I called for the 10% correction in Q1 of this year. Like we talked about, it was almost like a pain-free 10% correction.
I think a lot of people are watching are saying that was not pain free. I don't know what you're talking about.
Well, fair.
To me, as an advisor, I feel like
Yeah.
that was about as painless as you could possibly get when you live through a 10% correction. But I don't think it's done. I just don't. I think it's going to take another couple months for this to all play out. Hopefully, I'm wrong there. Hopefully, it bottoms in and we see a run. And Matt's right, and I'm wrong on this. But I think we're going to see some continued volatility. I would say definitely another 5% move to the downside. We could see another 10% correction, but I still think we end positive on the year. I just think it could be a somewhat volatile Q2. Second half of the year, this all plays out, and inflation is under control after the tariff situation plays out.
Mhm.
I think we're in line for a really nice run at that point.
Yeah. And at the end of the day, I always like to say it doesn't matter what we think.
Yeah.
I think that one of the biggest financial companies out there at the COVID bottom was saying, hey, the market's going to go down another 15, we think. So if you would have listened to them, you'd be out and missing hundreds of % return at this point. So
yeah.
Just our advice is always going to be ignore the noise here. Just continue to buy and hold. Remember that the best days in the market are within days of the worst. So if you try to trade this, you're going to trade on the worst. You're going to sell on the worst days. You're going to lock in that loss, and then the best days are going to happen. Just like this 10% correction that we just went through, we pretty much fully recovered. So if you sold that thinking we're going to go to 20, you missed the 10% rip we just went on. So just trust the allocation, buy and hold, move through it. If anything, look to buy. If you're sitting on some fixed income and you don't need it to generate any interest for you, you're not relying on it for income, you have that covered, maybe look to deploy that. Buy some of these US, large cap growth tech stocks that Matt's talking about that have taken a bit of a beating while they're down in value. Like Beppin said on the show last week, and it made me laugh, the stock market is like the only store where nobody wants to buy anything when it's down in value.
Always, right? Always. So,
right.
Isn't this the point, though, right? If you are concerned without doing anything panicky, is to talk with your advisor, maybe just kind of run through it, get a reanalysis, or just kind of get a little pulse check, for lack of a better term. Yeah.
Yep. That was the whole point of the article, saying, hey, stick to the plan. Everything's going as normal. 10% corrections are part of it. 20% corrections are part of investments. So just looking at the Magnificent Seven companies here, you've got Meta as the sole company that's positive year to date. And like I said, NVIDIA is actually down more like 16% today. It was down 10. But we had talked about maybe making another prediction. I'll double down on that NVIDIA prediction and say I still think it might eke out being the number one returner. That's a pretty bold prediction, but I think a lot of this correction's been overblown, and it's a very fundamentally strong story with the AI revolution we're seeing.
That number is not even accurate. What is it down today? Isn't it down another 5% plus today?
Yeah, so it's probably 16% down. So Meta has over a 20% head start on it. But
wow,
very bold. Okay.
Well, I guess depending on how you're sitting too, you might consider that buying opportunities, right?
Oh, for sure. Yeah.
Because it's down. We're supposed to do. We're supposed to buy it when it's low and sell it when it's high.
You got it. Then kind of rolling through my predictions here. So my S&P price target maybe a little rosy at this point. Bonds are acting like bonds again. That's been a huge one and a big detractor for investors who are maybe just a 60-40 investor who have 60% stocks, 40% bonds. You are literally probably negative on that 40% bonds over the last 5 years. And we're finally seeing bonds go up when equities are going down. They've been so correlated for the last few years. It's a nice, it's very nice.
That relationship
back to normalcy right there, right? Yeah. It's been a while.
I'm speechless.
Yeah. Back to a bit more of a normal relationship for them.
Yep. And then, part of that is the Fed, what they're saying. And I had said, I think they're going to cut 3 or more times over the course of the year, which when I said that, it was priced at maybe like 5 to 10%. And we are seeing
it was a very bold prediction. Yeah.
Yep. And we are seeing about a 50% likelihood of that. So we've seen that go up by about 5 to 10x, depending on the day. So 50%, we see 3 or more rate cuts. Reason I made that prediction is I saw 2 paths to potentially more rate cuts, and that was pain, which we've seen, and inflation coming in better than expected, which we've seen. And that's why we've seen these rate cut odds increase. Now, that doesn't mean a rate cut's coming. This is more back half of the year.
And again, we need to see how tariffs play out and how that affects inflation. So it's going to have a lot to do with it. Then did you give me, is this 3 green check marks? Are you declaring all these wins for me here?
You're doing good. So, I mean, the S&P did have a 10% drawdown, 10.6.
Okay.
And then if we go to emerging markets over here, emerging markets is that purple line. We're at 6.7. S&P's still in the negative territory. So
Small caps aren't looking so good.
no, but hey, you hedged your bet and said either small caps or emerging markets, and this might be the year. Emerging markets finally turning around, and it was just so dislocated on value. I think that was a good guess. And
They were so beat up. And then Beppin and Mike showed a great chart last week, just talking about the first half of the first year for a new administration and just implementing different policies and what that can do to volatility in the market and growth. And it really hinders it there. So my whole, my logic with this prediction was emerging markets, lower correlation to the US market than developed nations, and international developed has done actually really well too. But that was my play. I thought there was going to be a pullback in the market here, and I didn't think emerging markets was going to be up, 6-7%, but I thought maybe a few percent, and that'd be good enough to beat the US markets. That being said, a lot of people have asked, so should I throw like 30-40% in emerging markets? No, it never becomes a core position. Smaller allocation to it, 5, maybe 10% at the most for a short-term play. But this is exactly why we want to own these different asset classes, because you're going to see the U.S. markets perform poorly and they can do well. So it really it brings down that downside.
yeah, it's kind of funny how the market finds a way to punish people. So the U.S. market was doing so good for so long. Emerging markets has been underweight in a typical portfolio. Bonds have started to become underweight in a portfolio, and more of the portfolios we've seen have been so Magnificent Seven dominated, which is probably okay since we've had this little correction. But we knew that was going to be an issue, and the market likes to punish you when you're offsides in your allocation.
Well, when you see it year after year too, we've been kind of spoiled. It's like, why don't I want to own the stuff that's going to outperform every year? And then you see something like this happen and you give back a lot of those gains. And this is exactly why, especially when you're in retirement. And then the value outperforms growth. This was really a valuations play, to be quite honest. I mean, Matt talked about how expensive some of these large cap growth stocks were becoming, and you look at valuations were so low, they were selling at a discount. And I do think what's going to happen as all this gets figured out with the whole tariff situation and inflation starts to come back down, which I think we're winning. But again, I want to see how these tariffs play out. I think what you're going to see is folks start to roll out of value, maybe back into growth at these lower prices to try to capture some of that return.
Right. And at the end of the day, we're not saying it's all over by any means. In 2018, 2019, with the China tariffs, we actually saw a 20% decline in the market, and we know what the market has done since that time period. So it's not a get out of the market and try to get back in kind of thing. It's just it might be painful, but at the end of the day, pain is the price you pay to play the game of markets. So
true, very true. So Matt, you've tossed out a couple little predictions. Do we want to do this again and see how it shakes out at the end of the second quarter?
We will definitely revisit it.
Let's see how these predictions play out, Mark.
Yeah. I mean, why not?
Exactly. We'll see how many green check marks there are. If they turn into red X's, no, we'll throw this away.
So do you have more new ones? Because like you're still holding up on NVIDIA, but do you have any other new ones?
So I feel like I have to match that. So what was the prediction? You're taking NVIDIA to lead the Mag 7?
For the whole year, yeah. So I'm going to say they take themselves out of the hole and come back, yeah.
Okay. I will say the same thing about Bitcoin. I think Bitcoin leads the way.
Is that a layup?
Right now it's down 6.5%.
Okay.
So it's right in line with some of those other stocks that Matt talked about. I mean, we just announced a Bitcoin strategic reserve. You're seeing states now announce it at the state level. They want to reserve. Other countries, I think, are going to follow suit. And I think we're going to enter some I think we're going to enter a supply crunch, to be quite honest. People are buying this and they're holding it. They're not speculating. They're not trying to get in and out of it. Most people are buying it and saying, I have my 1 Bitcoin or my half a Bitcoin and I'm going to hold it as a hedge. And I think we could see, I'm not one of those people saying you're going to see $1 million Bitcoin this year, but I think you could easily see 25, 30% growth, maybe a little bit more the rest of the way.
Yeah, it'll make you look either really stupid or really smart. So we'll see.
I'm not arguing that it does anything. It's digital gold. I'm saying that, but
I get it. And
people are buying it as a hedge, and it's not going to stop. And now you see institutions buying it. And now you see those folks in the 50s, 60s, 70s. Exactly. You see the boomers now buying it through the ETF. So I just don't think it stops.
Yeah. I don't doubt it. I don't doubt it.
That's why this is my bold prediction.
Yeah. But at the end of the day, I do think most of the pain has been felt already. But like Steve said, there could be more downside. But at the end of the day, the whole point of having a plan is to withstand all this. It's not to get out of the market and get back in at the right time.
Yeah. Well, to Steve's point earlier, he said it felt fairly painless, and I guess it depends on your definition of pain. When you go to give blood, right? Somebody might say, "Oh, you hope for a good phlebotomist that doesn't cause you too much pain when they poke you." Sometimes you feel it, sometimes you don't. Maybe that's the way this correction was. So, we'll see how that shakes out. All right, any final thoughts before we go? Are we good?
We are good. Thanks for listening.
All right. Well, as always, folks, if you got some questions, if you got some concerns, if you want to, challenge back on some of these predictions or just make sure that you're on the right path for yourself, reach out to the team. We got links in the show descriptions below. As always, you can find them online at Retirement Approved. Don't forget to subscribe to us on Apple, Spotify, YouTube, whatever platform you like using. Little thumbs up and notification bell so you catch new episodes when they come out. And we'll see you next time here on Retirement Approved with Matt and Steve Paul. Check those show descriptions below for links to reach out to the guys, and we'll catch you next time.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.